Hello guys, welcome back to my YouTube channel Options Behavior. So today we are gonna discuss about the option selling in stocks. Okay, so this strategy is useful, in selling options stocks, and when you have, at least have a specific view of that this particular stock that you're going to make, and the stock doesn't have that much capacity to move, at least 15 to 20% in either of the direction. That means from this strategy, you are going to cover the big range, even if you sell options. Okay. Uh, so you will definitely cover the big range. Okay. And like most of the times, the stocks doesn't move that much drastically, but anything is possible in market, right? But still, if you see the neutral movement of any stock, okay, maybe if that moves about 10% or 12%, then still you are in safe zone. Okay, so with that view, you can make this strategy. And the only thing is that you will have to keep in mind um, about one thing, that is you will have to uh, find such stocks which has high liquidity in options. So that is the primary criteria. And apart from that, it needs a little bit more margin because we will be selling more options than buying. Okay, obviously we will be hedging at a certain point, but still we will be receiving more credits, right? So if we are receiving more credits, that means we are selling more and buying less. Correct. That means we are selling more premiums than buying. So let us start, and this video is not going to be too much long because this is a very simple strategy and simple and useful definitely because this strategy covers huge range. And keep in mind that you will have to make this strategy. First of all, the first criteria is that you will have to choose a liquid stock. I mean, wherein the options are very liquid. And second point is you will have to start this strategy at the very beginning of the monthly expiry. Okay, that means the first day of monthly expiry. So or maybe like couple of weeks. Just yeah, even if 3 or 4 days are remaining to start the next month's expiry, then also in that case, if you are seeing all the options that you want to sell are in liquid position, then you can sell. Okay. For example, like as you can see my screen, right? So State Bank of India, the options are very liquid for this stock. Okay, you can take anything. Infosys is also highly liquid. Then mostly banks and IT stocks have very high liquid options, right? But obviously the selective stocks. So let's start the main crux of this video. Okay, so for example, I'm just taking the 31st March of expiry because anyway we are just 1 week away from the next month's expiry, right? So and if I have a V for SBI Bank, that it is not going to move, at least 15%. Okay, or maybe even if that moves 15%, right? But it is gonna take some time. Okay, so with that view, I'm going to create this strategy. Okay, so first of all, what I'll do is, for example, currently this is having a price of the spot price is 515, right? 515. So let me select 580. Okay, so 580 call options, which is trading at 4.5 rupees. Okay, so what I'll do is I'll buy this call. Okay, and I will try to sell such an option, such as strike, which is okay. So what I'll do is I'll sell two lots of this. Okay, why? The reason is I want to receive more credits, right? As I said, the premium should be received more then whatever we have bought, right? So I have bought at 4.5, but I'm receiving around 6 rupees. So that means 1.5 5 rupees I'm receiving more than what I'm paying, right? So in that case, so one side is done. Now similarly, you will have to find some of the options. For example, if I sell for 40p, okay, so I'll sell for 40 and then I'll be buying. So it will be, you will not receive much. So what I'll do is, I don't think 450 is there. Yes, 450 is also there. Yes. So what I'll do is I'll buy this one. Okay. So since what we are receiving over here is not, so that is why, right? I mean, you just have to consider that whatever you are selling, it should be the total sum should be greater than what you are actually buying. Okay, so selling should always be greater value, okay, than what you are buying. So what I'll do is I'll delete this one, okay, and I will try to find some of the options. For example, even if I sell this one, okay, sorry, if I just sell this one and if I buy for 60, okay, I think this should work. Yes, right. So see, now the middle part should be always in green, and it should be, some specific percentage of profit. Okay. So now, first of all, you will have to create this strategy. Okay. In that sense, wherein you will be selling more. Okay, and buying less. Okay. So at least you should be keeping 1 to 2 rupees of difference. Okay, the way I have done, right? So like I've sold around, um, almost 8 rupees, right? Not 8 exactly, but more or less, okay, 7.5 like that, 7.6. And here I am just buying 5 rupees, right? So actually I am receiving credit of 2 rupees from put options. Similarly, I am receiving some credits from the call options. So what is the advantage of this? First of all, see the probability of profit is almost 90%, right? That means there is a very high possibility of making money from this strategy. Okay, although the capital requirement will be this will vary depending on the lot size of any stock. So State Bank of India is having a lot size of 1500. Okay, so for that it is gonna block about 2,50,000, right? And for some of the stocks which is having 200 lot size, right, or 250 like Reliance, so it might require bit less. Okay, so anyway, so as you can see, upside you are safe. At least you're gonna make some money till 20% of the movement of the stock. That means even if you are expecting that, I mean, if you see that the State Bank is going to make such high, right, maybe 10% or 5%, 10% or 15% is still, you should be in a safe zone, right? 15%, see, you are having a very good profit, and even 19% you are 20 till 20% you are making 9,000, right? Similarly, so 20% is a very big range, guys. Okay, and put size here, you are at least safe, or you can make money till 15%. So 15% from downside and 20% from upside. So we can expect a stock, right, to at least range between this specific zone. So if we combine this, in the total range, so right, so it gives around 35%, right? So you can see the lower break-even point, right, which is at 436. Currently, it is at 515, right? That means you will start making loss only if it breaks that 436. 36 from lower side at lower side, and you are safe till 624 points. That means about 110 points from this spot, right? So 110 points upside and same more or less same point in downside, you are safe, right? So that's covering a huge range, guys. So if you are really interested in selling options of stocks, okay, so try to make such kind of thoughts, and you can make money by selling options. And obviously, if the market or the underlying does not move in any of the direction, right, or maybe it just takes a 5% or 10% of movement, then you should be quite safe. Okay, at 10% either side, I'll be making some money, right? And definitely, if it expires at uh, the the age of the graph, right? So obviously you're gonna make money much more than expected, but that's very rare scenario. I would not say that, but at least you should be you should be picking such stocks which doesn't move that much. Okay, in a month. Okay, uh, mostly Reliance you can take. Okay, and Infosys also little bit safe. So you can means as per your concept you can think, and even if you are having some view of that specific underlying, then you can make maybe the way you are seeing right now, right, that upside, maybe you are expecting this State Bank of you are having a view of that this specific State Bank will move upper side, maybe not today or tomorrow, maybe in a week or two, right? It can take a higher move, so you can keep that range bigger, right? And so you can sell the further options, right? So similarly, if you have a bearish view, then in that case you can make this specific zone larger than this one. So that depends on your view, or maybe if you are neutral, then you can make it equal either side. Okay, it should be symmetrical. So that depends on your view or your um, or maybe your expectation. So that depends on that. But anyway, even if you are not sure about the view of any stock, but at least this much big range either side, you can make money. But obviously, maybe the moment you deploy the strategy, you might see some rates on your screen. The reason is because because of IV spikes, right? So what will happen is the premium will be added, right? So what happens is you can see some notional losses. The loss that you'll be seeing might be notional. The reason is you will just have to focus on the graph. If your graph is, or if your underlying is just traveling between these range, even if uh, you know you I mean that I mean you are seeing some losses on your screen, right? But if you are checking on your graph, right, and if it is showing that okay, I am still lying under the green zone, then I should not worry about that. That is just our notional losses. Finally, the days pass on, and you will be in profit gradually. So because option selling is nothing but we just try to benefit out of the theta decay. So theta decay will only be impacting when the moment we will be gradually moving towards the expiry. So then only it plays its role, right? So with that sense, you can make this strategy in any of the stocks that that you mostly trade, or maybe that stock, right? Because some people have the capability of identifying their specific stock, because they do only specific I mean they just trade on the specific stocks, on the very selective stocks, maybe five stocks or 10 stocks. So what happens is, on gradually trading on those specific stocks, you have finally you have got the capacity in yourself that you identify that stock very well. Okay, that this stock has this much of movement. okay, in a month, 5%, 10%, then in that case, making this strategy will be much easier for you. Okay, so obviously, the more effort you put in identifying these stocks, right, or you're making your trades better, obviously you'll be making more money. So this is what about this strategy, guys. I hope you have liked this strategy. And in worst case, you know, in worst movement like sudden fall or sudden crash, see sudden crash or black swan event, option seller they face this difficulty. There is no option. But definitely you can, if you have money, then you can sell or buy more. Once your break even is broken, right? So that depends on your capital and so. But anyway, black swan or anything that doesn't come very frequently, right? 5 years, 10 years, that depends. So, but still, 5%. I mean, 20% is also a very good safe zone, right? So you can make money and I'm sure that you would have, I mean, you would be doing this strategy if you're really an option seller. So, hope you have liked this video. If you have liked this video, please do share, subscribe, and share with your family and friends. Thank you, guys.